If you are a salary earner in Nigeria, this video might save you years of financial stress, because today I will share 5 safest investments for salary earners in Nigeria, especially if you don't like stress, you don't want daily monitoring, and you want steady, predictable growth. Now, let me be clear. Safe does not mean zero risk. It means low risk, structured, regulated, and suitable for someone who earns monthly. So if you earn salary, your biggest advantage is consistency, not big lump sum. So let's get into it. The first one, of course, is treasury bills, because treasury bills are one of the safest investments in Nigeria because they are backed by the full face of the federal government of Nigeria. As a salary earner, this is ideal for some money that you know you will not need at least between 3 to 12 months. At least if you are saving money for something like maybe your rent, or you want to keep the money for something else that is not really urgent at that moment. And it's also good for short-term savings. So if you are saving money for rent, school fees, or any, let's say, termly fees, this is where your money should be, not in regular savings account. But the truth is, treasury bills alone cannot build you wealth, cannot build wealth for you. And that's where the next investment idea comes in. So the next on my list is money market fund. For salary earners who want better return than savings accounts, money market fund is a solid option. They invest in treasury bills, short-term government securities, and fixed deposits. What makes them great for salary earners? 1, low risk. 2, you can access your fund anytime you want it. 3, easy monthly contribution. You can set automatic debit on your account, and every month that amount that you set will be debited straight to your mutual fund account. So if your salary enter your account and sits there quietly, inflation is eating it. Money market fund helps you fight that. You can get between 15 to 20%, or even above 20% during some time, but it's better than savings accounts. But if you want to grow your money beyond just safekeeping it, try balance fund. That's number 3, of course. Balance funds are perfect for salary earners who have a moderate risk tolerance, want controlled risk, and they want a long-term consistency. Balance fund, they invest in the midst of a stock and some other fixed income investments, which means when the market is good, you grow rapidly. Your money grows rapidly. And when the market is slow, at least your money is a little bit preserved because of the part of the money they put in fixed income assets. This is where many Nigerians with moderate risk appetite should be. But many people are not investing in balance fund because they think investing must be either extreme or absolutely low. Balance funds are for people who say, I want my money to grow, but I also want peace of mind. Or if you earn in Naira, you already know the pain of how Naira depreciates, especially when you are running a small business on the side that needs your money to be converted to dollars before, or you are saving money for education abroad or anything abroad. You know how Naira depreciates. So, but this particular fund, this particular investment I'm going to mention right now will fix that for you, at least to some extent. So let's talk about dollar mutual funds. Dollar-dominated mutual funds will help you protect value, diversify your portfolio, and gives you hedge against Naira depreciating. Like I said, this is especially important if you plan to travel in the future, your children may study abroad, or you are thinking about maybe long-term investment abroad or something of that nature. You don't need to convert all your savings to dollar and invest. But the truth is, ignoring a dollar completely may be risky, because at the end of the day, Naira depreciates a lot and it's very unstable. That's just the truth. Finally, let me share the one that ties all these things I've mentioned together: a portfolio. A simple, structured portfolio. If you can afford the service of an investment manager, well, that's good. But you can't. If you can't, you can do this yourself. You can decide to build this in stages. For instance, let's say your emergency fund goes into money market fund, and maybe some parts, the school fees that you will need to pay for the next session, will go into treasury bills. Then something like this, if you want to invest money, travel abroad for holidays, or you need something in dollars, that should go into the dollar-dominated fund. For a long-term growth, for instance, the money you know you will not need in the next maybe like 4 years, 5 years, you can put some of them in a dollar denominated fund. And if you have appetite for it and you have risk and you have time to do some research, you can go in and pick up all these premium stocks and just put your money in there and leave it for like, let's say 4 years. It may not be much. Little money like 10,000 can start doing this, doing some of this. The truth is, as a salary earner, you will win by structure, not by jumping in from one investment to the other. You can just pick out the ones you want, structure it and say, okay, at the end of the month, this money goes into mutual fund, this money goes into dollar denominated fund, this money goes into maybe balance fund. And the good news is some of these investments you can start with 5,000 is not much, but as you build it in years to come, it will become something tangible. Most people, don't like investment, not because the investment failed them, but because they don't have plan. You need to make plans. As a salary earner, you need to make your plans so that this thing can be easy for you to flow, easy to flow. So if you research about an investment and it makes you anxious, just forget it. Just leave it. Finally, I just want to leave this with you. Start small, build structure, and stay consistent. If you find this video helpful, please don't forget to hit the like button and share with someone who might need to see this. Thank you so much for watching. Bye.